Are you a discount shopper? I mean, do you spend time and effort trying to find the best deal you possibly can? Now, if you are, that's totally fine. I don't blame you. But just understand that when it comes to Forex trading, you got to leave that shit at the door. Now, don't take my metaphor too literally. I mean, as Forex traders, we're always trying to get in at the best price, but to a point. There's a time and a place for everything. And in the system that we trade here, there is definitely a time and a place. So in this video, what we're going to do is talk about the one good time in our system to use pullbacks. It has a lot to do with the baseline that we just talked about. That's why this video is going here. And then generally why you should avoid them otherwise. 99% of the time, probably more, closer to 100% than 99%, we are going to be avoiding pullbacks. But there's one time that if you are able to pull this off over and over again, year after year, it's going to add up. So it's really worth talking about, but just understand also, this is tough for me. I think I do a pretty good job of explaining things, but a lot of times when you have something in your head that is distinctively yours and you're trying to tell other people about it, it's not always the easiest thing. I mean, I haven't even done it yet, but I can already tell. So out of everything we do, this is going to be a pretty advanced concept. So if you can pick up on this, you're good to go later because it's not going to get any more advanced than what we're going to talk about. But if for some reason you can't, instead of trying to ask a bunch of questions and trying to figure it out, I would just go ahead and not even worry about what we're about to talk about here. Because you're fine if you skip it. But like I said before, this is something that if done right and if done at the right times can be really good for you, but it is not a deal breaker, I don't think, in really any sense. But I do know not everybody is going to grasp this. But do your best and just know that we are going to get nerdy, and this is probably the peak of that nerdiness throughout the entire course. So it's not going to get even more hard to understand after this. This is probably, about as deep as we're going to go on any concept. So, moving on, let's talk about what a pullback is first. Some people might not know. So, the way I define it is a big candle followed by a smaller candle going the other way. So if you have a candle that goes long 100 pips and you have the candle right after it go 25 pips the other way going short, and you enter instead of entering on the long candle you just saw, that's considered a pullback. You officially got a 25 pip discount on that trade. And some traders will often wait for this phenomenon to happen before they ever trade. In their minds, they're like, well, if I can't get a discount on the trade, it's just not worth taking. This is absolutely crazy, but we'll talk about that later. For now, we need to talk about how this fits into our system that we trade here. If you are seeing this video for the first time, or not this video, but if you're seeing this channel for the first time, and this is the first video you see, this is not the place to start. It's going to get really confusing real soon here. So I put the beginner's video in the description below. Even if you're not a beginning Forex trader, we do things completely different. Do yourself a favor, check out that video first. You're going to like it. But for the rest of us, we are going to move on. And when it comes to pullbacks, the pullbacks I'm talking about that have opportunities in our trading system, the No Nonsense Forex way, are larger candles. And you'll see what I'm talking about here. But when I mean big candles, I don't mean the super gigantic crazy ones like the Euro-Swissy crash or the Brexit candle or anything like that. I'm just talking about the ones that you see to where you're like, wow, that is a much larger candle than normal. Where the hell did that come from? So the reasons you typically see candles like this occur just kind of out of nowhere is just a news candle. So it could just be a reaction to the news one way or another. It is often big banks doing some stop hunting. They noticed there was a big opportunity to go ahead and shoot a candle really big one way or another and trip a bunch of stop losses, trip a bunch of orders and then start taking price the other way. I refer to them often as FU candles, like when you're in a trade that's going really well and all of a sudden this huge candle shoots the other way. Candles like that, if they're not news driven, are often always big banks driven, or sometimes it's a combination of both. Or sometimes prices just actually going that way and it's going there very quickly. That can happen for sure. You might get a candle going long really big, and then it's just followed by more long activity. You just don't know. But what I can tell you is that these two candles right here are often overreactions in the market. And when overreactions happen, price shouldn't actually be where price is right now after these big candles get done finishing. And in these cases, you are almost always due for some kind of retracement or a complete reversal from where that big candle was actually traveling. And that's where we can really take advantage of pullbacks. Sometimes from a winning standpoint, to where we can actually get in at a better price and get more pips when price does actually start going our way. Or as a protective measure, because now that we have this baseline in place, we have a brand new tool that can help us make our losses even smaller. And because of that, we can now bring pullbacks into our trading, but only in certain situations. Get your notes out. Here are the rules. All right. So pullbacks only apply when price in one candle, not a series of candles, just one, has crossed your baseline and closed beyond it, but like way beyond it. And we'll put some numbers behind it in a second here. Here are the numbers. 1 second. The rule is you do not want to enter that trade if price has traveled more than the actual value of the ATR beyond your baseline. So, for example, if you're trading the euro dollar and the ATR is 80, now price is sitting below your baseline right now, but by tomorrow it has crossed above your baseline, but it has gone 100 pips beyond the darn thing. You're not entering along no matter what the rest of your algorithm says to do. If price has gone 85 pips beyond it, no, you don't get to trade here. Anything over 80, which is the ATR we just made up, but anything over 80 in this case, you wait for a pullback and you only give it one candle to do it. If by this same time tomorrow, price is now 72 pips beyond your baseline, you can now go ahead and enter. And you will have entered that trade 28 pips better than you would have the day before. Now remember, before we move on to the next slide, this phenomenon only happens when this happens first. That has to happen before any of these rules kick in. So you can pretty much wait for it to happen, because it doesn't happen too often, and then come back to this video to see what to do if you wanted to. Because everything we're talking about in this video here only applies when this happens first. All right? So before we move on to the next slide, let's go to my charts and I'll show you an example. We'll go slow here. And here we are at the euro dollar daily chart. I went ahead and put up your everyday usual suspects here, the ones we've been using, the 20-day simple moving average. We have the Chaikin money flow as our confirmation indicator, and then the ATR is down below. Now, I had to really hunt for these because, like I said, they don't happen too often. You just need to know what to do when they do happen. So you will see in our system, we have a long trade right here. Price crossed and closed above our baseline. Our confirmation indicator agrees. Here's the issue. Let's take a look real quick and see what our ATR says right at this time. This is all the way back in 2017, early 2017. So the ATR is at 100, rounded off to 100. So we want to know from right here where our baseline is to where the candle closed, how many pips is that? Now, if you want to be lazy and get an inaccurate result, you can just drag and see. It's about 101. But the best way to do it is just to hover over it and say, okay, right there it is 0501. So round it off to 0502 as far as the price. And at the very top, it closed at 0605. You know, you can kind of round that either way. But from here to here is more than 100 pips. So you would not have taken this trade. What you would have done is waited for the very next day, and you give it one chance, one candle for this to happen. Like I said before, we don't subscribe to the one candle rule on the baseline, but this is an exception to that exception. That's why this is tough for me to explain to people, but I'm hoping you guys have been following along. If you have, this will be a bit easier. But because the next day we definitely got a pullback, and now price is only, let's go ahead and be lazy here because we know, only about 33 pips from here to here. Now we can go ahead and enter this trade. We got to make sure that our confirmation indicator still says go and everything else we have still says go. And if it does, instead of entering here, we entered about 70 pips better, which is pretty great. I mean, we would have gotten all this plus 70 pips more than we would have had before. So you're not going to find these occurring often. But when you do, that is how you execute it. You must wait one more candle for price to pull back. And if it falls under your ATR, under the value of the ATR, you officially have a pullback trade and you take it. So that's how that works. Now let me tell you another reason why we do this, or show you another reason why we do this. I have the date written down. Let's go ahead and find it. It happened in October 2017. Where is it? Right here. So with this big old candle right here, you might have gotten the signal to go short. Like I said, this is just an example. I don't know really if the Chaikin said you can go short or not. But maybe it did on the very next candle because you are allowed to let your indicators catch up. But we know, and you can pretty much tell, that this is a situation where price has just traveled too far. So whether you entered here or here, we can even just pretend it's here. Let me see what our ATR was. About 75 pips. Yeah, this is going to be way further than that. So you measure up to the baseline, yeah, 124 pips. You just flat out wouldn't take this trade at all unless on the very next day this candle came back long and fell into that buffer zone of under 75 pips from the close of the candle to the baseline. But because it didn't, you just wouldn't have taken this trade at all. And it's probably good because there didn't really seem a whole lot of room for you to make anything, and then price would have gone the other way. And you might have lost money there. In my experience, situations like this when it comes to pullbacks happen more often than the example I showed you before. But both of them are good. You either got a nice little 70 pip bonus, for example, like we did on that first piece, or you were able to eliminate what would have almost certainly been a loss in some capacity. And at No Nonsense Forex, we love eliminating losses. So any chance we can get to do that, we're going to do it. Now, if this whole thing wasn't complicated enough, there is one more situation we need to talk about because it does come up. So if you're in a situation, and we said it's okay to do this in the last video, where you have a signal to go long, for example, because price crossed and closed above your baseline. but you're just waiting for your indicators to catch up, which you're allowed to do. If when they do, prices travel too far, and it is more than 1 times the ATR, then again, you don't want to trade. Don't even wait for a pullback. We're only looking for a pullback after that one really long candle. But I mean it when I say if price is already further away from your baseline than the value of the ATR, I don't want you getting in these trades, because then the baseline can't really do its job effectively. Baseline, one of the biggest reasons it's there is not just to help you enter trades better, but to protect you from losses. And when price is too far away from it, it really can't do that. I'll show you an example again. So I'm back on the exact same chart, all the same tools on it. We are just further ahead in time. We have leapfrogged into 2018, and it is in August, and this happened. So this is not a situation where it's a pullback situation. This is just a continuation on the concept I just got done discussing. All right, stay with me. So you have a trade right here, right? You just got to see if the rest of your system agrees. So let's take a look. Is Chaikin on board with a long? No, she is not. So we got to wait. What about here? Not really. Here? That'd be really nice, right? Nope, not there. You don't get a long signal from your confirmation indicator until either here or there. You'd have to really kind of zoom in and see where you got it. But let's just say it was even here. Your ATR at that time was what? 85 pips? It's going to be more than 85 pips. From here to here? Yeah, almost 150 pips. So in a situation like that, like I said, this has nothing to do with pullbacks. This has everything to do with how far away price is from your baseline. If it is more than the value of the ATR, and in this situation it certainly was, you don't take the trade. And again, it was a good thing you didn't. There was no money to be made. You would have lost, most likely, over time. Your exit indicator would have taken you out. Your stop loss would have gotten taken out. Something would have happened here to create a losing trade. But the good news is, because you followed the rule I just told you, you were never in this trade. So again, this has nothing to do with pullbacks, even though this is the pullbacks episode. This is just a continuation on what I just shared with you. When price is higher from the close of the candle to the baseline than the ATR is, number-wise, you don't take the trade. So I really hope everybody understood what I just went over. The hard part's done. We have reached the peak of things that are hard to understand in this entire video series. But one thing I really want to touch on while we're talking about pullbacks is when they work so well. Sometimes you get it in your head to, again, deviate from your system and use pullbacks where you shouldn't. All right, I call this pullback-itis. It is very easy to, what is it when you get a disease? To contract, and it is very hard to get rid of. So let's just give you a little vaccination now, and it will hopefully not happen to you, because the results can be devastating. So what do I mean by pullback-itis overall? When it comes to pullbacks in general, only use this tactic when it applies in the exact specific situations that I showed you earlier in the video. That's it. Don't use it anywhere else. You're going to want to. You're going to say to yourself, hey, I think price might be pulling back here because I'm a clairvoyant who can predict the future. And I'm also full of shit. Don't let this happen. Even if, for example, the ATR is 80 pips and price is 79 pips away from your baseline. If the rest of your system says go, go. Don't wait for a pullback. Stay rigid on this. On a pair that typically has lower ATRs like the euro dollar or like the euro pound, if the ATR is 80 and price is 79 pips away from your baseline, you're really going to want to wait for it to pull back and get that discount because it's going to seem like it's far away. But you have to follow the rules here, because as soon as you allow this to happen, you're going to allow it to happen in other places, and then the disease is just going to spread throughout your entire body. Now, the reason why it is so important to not even start this train from leaving the station is because our system already has great loss protection built into it. We're just adding more and more pieces as we go to make it even better in this regard. If you start trying to add pullbacks where you don't need to be using pullbacks, you have a really good chance of missing out on a lot of big winners. And there is no excuse for missing out on winners that your system gave you. I don't get mad when I lose trades, like nowadays, like at all. But if for some reason I got caught slipping somewhere and I missed out on a big winner that I should have been a part of, I am irate with myself, because those big winners are really going to affect my bottom line at the end of the year to where it's going to eat at me. I'm going to look at my bottom line and then think to myself, man, what would that have looked like if I didn't pass on that 300 pip trade? Because I did, and there was no reason to. But contracting pullback-itis is a great way to miss out on big winners all the time. Because as we said before, sometimes price can just keep on going. There is no reason why it can't do that. And if you're busy nickel and diming where you shouldn't be, then you don't deserve to have those big wins. That's what my intro at the very beginning of this video was all about. You can be a discount shopper and try to get a better price on those very few situations where it actually applies. But if that becomes who you are, so many of those big trends to where all of those pips go right into your pocket, like we spoke about before, no longer go into your pocket. And everything you worked so hard to put together no longer benefits you like it is supposed to, because you allowed this to turn you into a discount shopper. Don't do it. In conclusion, use this tactic when you are supposed to. It can be really good, because the odds are after a big candle that crosses a sensible baseline, price should pull back the other way far more often than it doesn't. But don't use it anywhere else. I just got done ranting about that. We'll leave it there. But remember that other concept that I tacked on. Just in general, even if it's not a pullback situation, avoid trading when price has gone too far beyond your baseline and you want to enter a trade. So the equation for that is just when it's gone further beyond your baseline than the ATR is. Easy. Because at this point, you really don't have one of the major benefits a baseline gives you. So just avoid it altogether. You're going to be better off. And just know, guys, the regret is heavy. Missed wins will kill your bottom line. So don't let pullback-itis happen to you. Now, if you really don't like money and you have not subscribed to this channel yet, do it now. Hit the bell. So much good stuff coming. In the next couple months, we have some of the best videos that this entire channel is going to provide. A handful of videos that many of you have been asking for. And next week, we're going to have one more concept on the baseline that is really big. It is a concept that happens more often, far more often, I think, than pullbacks do, and something that's going to put a lot of money in your pocket over time. So get ready for that. Keep banging it out and putting in the work, and go get it.